Hello everyone, welcome to the Market Outlook for the month of May. I'm Marian and I have with me Steve Price, Chief Investment Strategist. Welcome Steve.
Thank you.
The US economy has once again disappointed in the first quarter and the Chinese economy is weakening. Is this a concern for you?
I don't suppose we're too concerned about it if you look at particularly developed market growth. If you're looking at US data, yes, it's weakened in the first quarter, but actually the leading indicators still look relatively strong. The labour market in particular looks very strong despite a weak report for March. So overall, we're pretty constructive there. Europe is accelerating. Business confidence is picking up quite strongly, not just in Germany, which is what's being reported, but also in the periphery as well. Then you move away into emerging markets, and China is clearly leading the concerns there. We've seen significant downgrades in growth expectations across emerging markets. That does seem to be stabilising, so it's certainly not a really optimistic outlook for emerging markets, but maybe the worst of the downgrades are behind us.
What does this mean for global monetary policy settings?
We still believe that global monetary policy settings will remain very loose going forward. So if you're looking at Europe and Japan still employing quantitative easing and will be for the foreseeable future well into 2016, there's even speculation that Japan could accelerate its asset purchases. Elsewhere in Asia, obviously we are seeing monetary policy being eased, led by China with the triple R cut that we saw in April. So those sort of things are going to come through in the coming weeks and months. The only thing, obviously, the fly in the ointment, if you like, is in the US. But even there, we've seen rate hike expectations being pushed back over the past 3 to 6 months. We do expect the first rate hike to be in later this year, probably around September or maybe slightly later. But overall, that shouldn't get in the way of still strong risk appetite globally.
Your investment team have performed well so far this year. Should investors book profits as we head into May to September period, which is often associated with the increased volatility?
We don't think so, and two reasons for that. One is, it's very difficult to know when and if any pullback will occur. So if you look last year, we did see some weakness in global equities, for instance, but that only occurred in September. It certainly didn't happen in May. So from the end of April to that September peak, equity markets rallied almost 5%. So probably getting out of the way of equity markets is not the way to go. But for investors that are looking to deploy money now into asset markets, we'd probably be looking at high dividend yielding equities in developed markets and also the covered call strategy as our primary areas of focus for new money being deployed in financial markets.
Your preferred equity regions remain Europe and Japan. Why is this, and do you still believe that investors should hedge the currency risks associated with such investments?
Well, momentum looks pretty strong into both of those markets, with in recent times hitting new highs. Certainly for Europe, all-time highs, and obviously Japan, more localized highs, but still the momentum is strong. Japan's earnings have been surprising on the upside now for 18 months and continue to do so. So that's still a strong driving force behind the Japanese market. And Europe looks like it might join that exclusive club in the coming weeks and months as well, with earnings revisions starting to show signs of picking up, obviously helped by the weaker euro we've seen over the past 6 to 12 months. So still very much our preferred regions from an investment perspective or an equity perspective. In terms of currency hedging, we still would hedge the currency risk. We do believe that we're in a period of consolidation now for the euro and the yen against the dollar, but we believe that ultimately those currencies will break lower again, so dollar strengthening against the euro and the yen, and therefore we still prefer currency hedge positions. Maybe not to the same extent as the dollar strength won't be to the extent we've seen over the past 6 to 12 months, but it will still come through to some degree.
We have seen Chinese equities perform very well in the recent past. Do you expect this to continue?
Well, we certainly have a preference for the offshore market to the onshore market. If you look at momentum on the onshore market, it's extremely strong. It's looking a little more bubble-like, though, in terms of the performance. We doubt that this performance can be extrapolated for a long period of time. Obviously, when it's like this, it's difficult to know exactly when the market's going to peak. But if you look at the offshore market, it's trading at a very significant discount to a share market. So that's where we prefer investments in China at this stage. The risk return just looks a lot more attractive. Valuations are nothing like as stretched. And overall, we're still overweight the Chinese market in Hong Kong, so the offshore market. So we're still pretty bullish there, but we'd be very, very cautious adding to any local onshore positions.
Energy stocks fell sharply in the second half of the year and has been consolidating since. What is your outlook going forward?
It's a very favourite question of a lot of our clients. Everybody seems to want to buy energy stocks. And certainly if you look at it from a valuation perspective, there's a good rationale for being invested in the energy sector now. So we see valuations actually, even before the sell-off, were quite attractive. Now clearly they're very compelling if you're looking at things on a 3 to 5 year basis. On a shorter term basis, earnings forecasts were cut very dramatically. Obviously with the decline in oil prices. We're starting to see those earnings forecasts stabilise, so maybe a lot of the bad news is already priced in. I suppose the key challenge though is, for energy prices to build significantly higher from here, you probably want to see oil prices move higher as well. And just as we've seen in energy stocks, oil prices have actually consolidated recent times. We've seen a strong bounce from very depressed levels, but it hasn't broken higher. And I think that's the key challenge. So 3 to 5 year time horizon, absolutely love energy stocks. But we probably would wait until we oil prices breaking higher above $60 a barrel before we sort of enter the energy stock space on a shorter term horizon.
Thank you, Steve. See you next time.
Thank you.